mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we help you learn to invest in 45 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How's it going, bro?
I'm very good, Bryce. Good to be with you again. I think the 45 minutes is ambitious.
Well, for this episode particularly, yes, but I think we've been sticking to it pretty well. Now, the reason for this episode where we're breaching the 45-minute rule, Ren, and that's because we did something different with this episode. We did a collaborative episode that is actually going to appear on another podcast feed.
Double the podcast, double the time.
Yes, world first for us.
No, not even.
Yeah, anyway. So we had a conversation today with Paul Benson, who is a financial advisor and host of financial podcast called Financial Autonomy, Ren. And
how many times did you say finance?
Yeah, I was just thinking that, quite a few. Paul will explain a little bit later on in the episode the reasons why we joined up, but I thought it was a fantastic conversation.
Yeah, it was good. I always enjoy speaking to other people in the finance podcasting community, the small community that it is.
Yes.
But yeah, look, we agree on a lot of things. We disagree on some things. It's always interesting to speak to people who have a similar goal. And so, yeah, it was a good conversation.
Well, without further ado, Ren, we'll leave it there. If you haven't bought a t-shirt, $25, equitymates.com/shop. Shirts are available, but we'll leave it there and jump into the conversation. Paul, one of the things that we like to start our episodes with is a game called Overrated, Underrated, where we usually ask our guest, I guess, a number of different asset classes or investing strategies to get an idea of whether or not you think they're overrated or underrated. But by the nature of this episode, general discussion, I think it'd be good if we could throw it around the room. What do you think?
Absolutely, yeah, that's fantastic. Let's jump in.
All right, so we'll start. We'll throw to you. Overrated or underrated, the ASX 200, and perhaps why?
Well, we're in November 2019, so at this very point, I would say underrated. And my reason why is that the risk-free rate at the moment for most people is a term deposit, and that's paying 1.5%. Dividend yield on the ASX 200 is a bit over 4 plus franking credits. To me, that seems excessively generous. So I'd say underrated on ASX 200. How about you two?
Seems like pretty good logic to me. Yeah, I think I was discussing this morning with a mate, and I agree in terms of where it sits relative to other returns that you can get out in the market. I think that there is certainly advantage to still being in the market at this stage. Ren, you're smiling. What do you reckon?
I'm always bullish on Australia, so long-term underrated.
Yeah, nice.
I like it. If for no other reason than patriotism.
Yeah, that's it.
Well, that flows into the next one. I might ask you, Ren, overrated or underrated leverage?
I'm going to say underrated, depending on your specific circumstances. But it's definitely something we've spoken a lot about recently on the show. And it's definitely something that I'm thinking more and more about in terms of my investing journey and where I am in terms of, my age and the amount of working life I have to go. We all talk about the impressive power of compounding, and I think properly using leverage and understanding the risks of it, but using leverage early and then allowing compounding to take hold is a really good formula for long-term wealth creation.
How do you think about it, Paul?
Yeah, I reckon you're on the money there, Ren. I mean, look, it's not for everyone, and I'm sure general advice and the normal kind of disclaimers there. But I mean, people that use leverage to buy investment properties every day of the week, and yet for some reason, if they want to leverage into equities, it's this scary taboo kind of thing, and it always seems odd to me. I think it stems from margin loans and the way about margin calls and that sort of stuff, but these days there's a lot of other ways to get leverage that don't have those kind of risks. So, yeah, I would put underrated on leverage for me. How about you, Bryce?
Well, Bryce is actually trying to leverage into old 18th century art. So.
That is not true.
Sticking up a Van Gogh.
Yeah, to your point, Paul, I think it's been something that traditionally I've thought as being, a bit out of my league in terms of my experience, and a bit sort of scary, and the risks sometimes outweigh the rewards, but also we've been thinking about it a bit more over the last few weeks especially, and there's some great products out there now that take away some of that risk, I guess, or at least let you access leverage in a more comfortable way. So underrated.
Nice. All right, we're in agreement. Well, I want to throw one out there. What do you guys think about Bitcoin?
You've asked a question that will split the room here. I've never been a fan of it. The first run up, I refused to get into it until it got right to its peak, and I probably bought on the day that it was at its peak, and then wrote it down. So
Right.
I wasn't a fan, and then I became even less of a fan. But Bryce might have a more positive view of it.
Well, I am still in Bitcoin in a very, very small exposure. That's not to say that I think it's underrated, though. I think overrated, I don't really keep an eye on it. Crypto, perhaps I can still see having some sort of utility going forward, but Bitcoin itself, as I said, not really across it anymore, so I'm going to have to say overrated. What do you reckon, Paul?
Yeah, look, I don't own any. I never have. Haven't been comfortable, but I don't dismiss it. So I guess I'd put an overrated on it. And I guess, rather than Bitcoin, I think, as you said there, Bryce, broaden it out. Crypto is probably a better way to think about it, cryptocurrencies. Don't own any, don't plan to own any in the short term. But I'm not someone who sort of says, it's all ridiculous. I mean, it's pretty much the same argument as gold. And in a world where we're heading towards zero interest rates and there's the potential for governments to be printing money, I don't know. I can see some argument for it, whether it's Bitcoin or some other crypto, don't know. But right at the moment, for me, overrated.
You've offended every gold bug out there by saying Bitcoin is the same argument as gold, but we'll let them come at you. So, Paul, I want to go from the most risky of assets in crypto to one of the safest. What are your thoughts on term deposits?
Wasted opportunity. So overrated, I suppose. Term deposits, I mean, look, the rate of return on those isn't even enough to cover inflation. So I don't know. It could be an instance. I mean, sometimes say if you sold an asset and you had a big capital gains tax debt, but it wasn't due for 6 months, so you just needed to park the cash until you had to pay the tax. Yeah, maybe you plonk it in a term deposit. I can see a few uses for them, but broadly, wasted opportunity in my book. How about you, Ren?
Yeah, I'm 100% on the same page. I think there are certain circumstances where you might want it, but especially for people who are just starting their investing journey and have a lifetime ahead, you're just missing out. You're missing out on opportunity, and it's going to hurt you over the long term if you're not even keeping up with inflation, but you're not taking advantage of some of the better opportunities out there.
Nice. Well, Ren, I'll throw one to you. Overrated or underrated small cap stocks?
Very underrated, especially in an environment where everyone's just buying broad market ETFs.
Yeah.
I love looking at small caps. I think the research process is a lot more fun. If you pick it right, there's a lot more upside there because they're at a different stage in their growth trajectory and journey as a company. So your chance to get outsized returns is a lot higher there than in the top end of town. And it's just more interesting. Like, it's who wants to research Commonwealth Bank? I want to find companies that I've never heard of before doing things that I didn't know were done. And that's in the small cap space.
Yeah, nice. Paul?
Yeah. Look, I love Ren's train of thought, and I agree. It's definitely more interesting. I kind of think of small caps as a bit of a hobby, though. If you're investing because, I don't know, you've got some sort of goal, you want $1 million in a portfolio so that you can retire at 40 or something like that. To me, small caps isn't where I'd pursue that goal, but I take on board Ren's point. If you're going to invest in large caps, and we might get into this later, but you might as well just buy the index, really. I mean, if you're going to be an active investor and choose individual stocks, at the very least mid caps, but probably small caps as well is where you'd want to be researching, I'd thought.
Yeah, I think we'll touch on that in a bit. Okay. One more to go.
I don't know that I gave an overrated, underrated there. I don't know how to hit that one. But, anyway, hopefully I've
neutral.
given some sort of coherent answer.
You thought my response was overrated.
Let's go with that.
Yeah. All right. I want to finish it up with one that Bryce has strong opinions on, so I'll throw it to you and then we'll hear from Bryce. Paul,
Sure.
What are your thoughts on the FIRE movement?
The FI part of FIRE, love it. Great idea. The RE, the retire early, I don't know. I don't quite get it. I mean, if you've achieved financial independence, then to me, you've got the choice to do whatever you like. Surely that's the goal you want, isn't it? I mean, maybe you do want to retire early, but what does that mean? Does that mean you're a great nomad who goes in a caravan up to Queensland for 8 weeks a year? I mean, I don't want to do that. I'm in my 40s. That's not something that would make me happy. So, yeah, I don't know. Sometimes it feels like a bit of a religion and it sort of turns me off a little bit, to be honest. But the FI element of it, yep, on board, love it. How about you, Ren?
Well, I'm going to throw to Bryce because he has very strong opinions.
I wouldn't say very strong, but yeah.
You can go back through the Equity Mates catalogue and hear some of his strong opinions.
I think certainly overrated. To your point, Paul, it feels like a bit of a cult religion. No offense to anyone out there who is deep into the FIRE movement. I think principally the idea, of reaching financial independence, setting goals, sticking to a strategy, investing for the longer term is great. I think what people sacrifice to get there at this age and time in life, and then I guess for the return that you get, maybe you'd be living on $40,000 a year. I don't know what sort of retirement that would get you, but yeah, I think there are smarter ways to achieve financial independence without sacrificing everything right now.
So Bryce is playing it diplomatically there. I think, and to quote him, I don't want to eat beans for the rest of my life.
Yeah.
Ren,
you said 40,000 there, Bryce. You said 40,000 a year there, Bryce. But I mean, there are some of these FIRE advocates, out of the US that are on talking about 20,000 a year to live off.
Yeah,
sort of
living
stuff.
in a bamboo jungle. I mean,
that wouldn't even get beans with that.
Yeah, essentially their life is, sitting in their underpants in front of a computer playing Warcraft or something.
Exactly.
Yeah. And which goes back to, the whole reason you try to invest and build wealth and that sort of stuff surely is to live a happy and interesting and fulfilling life, and yeah, I don't get some of those ones. I'm with you there.
But look, as much as we make jokes about it, I think whether we call ourselves fans of the FIRE movement or not, really what the FIRE movement is all about is just making money not the key driver in your decision making, having the financial independence to do what you want, and whether that's retire early or whether that's do a job that you want to do. And I think we're all broadly aligned with that.
Yeah.
Spot on, Ren. Yep.
It's just how we get there.
Yeah,
but anyway,
it's just good. It's good. It's easy to poke fun at.
Nice.
For sure.
So I guess that's a bit of an intro into the way we are thinking about a couple of assets and I guess investing strategies. So let's jump into a bit of our background before we talk about some more financial wealth creating strategies, which is why we're here today, Paul. But for our listeners who may not have been introduced to you before, do you want to give us a bit of a rundown on who you are and perhaps tell us your story about your first investment?
Yeah, sure. So, just to step back just slightly on that, for the listeners, so I reached out to you guys and suggested that, we put this episode together, and it was because, according to iTunes, there's quite a few of Equity Mates listeners also listen to Financial Autonomy and vice versa. So hopefully there's lots of people listening that have listened to both the podcasts before, but for those that either Financial Autonomy listeners that haven't listened to Equity Mates yet, obviously, I hope you give them a go, and it's a fantastic podcast, so I encourage you to do so. But for the Equity Mates people that have never heard me before, my background, so I'm a financial planner, self-employed, and have been doing that for about 20 years, was an employee as that for a while, and then self-employed since 2006. So been, running that way for quite a while. And, I guess particularly, the theme of the podcast and that sort of stuff is around that, financial independence and gaining choice, I guess, is a key theme that we think about. So first investment for me, look, it was back as a teenager. And I was fortunate. My grandfather used to work for Gyprock Plasterboard, for people that I'm sure that would still be around. And he got given, evidently as an employee, some CSR shares, and he distributed them amongst his, I think, 9 grandchildren. So we got about $500 each. And I don't know, can't remember exactly how old I was, but, 15, 16, something like that, I reckon. And I was a shareholder, and it was really exciting. And it was at a time where you used to get it's not like the chest statements that you get now. You sort of got a certificate, and that was really cool. And it was at the time, this was in the 80s, and the share market was doing all sorts of exciting things. 87, there was a big crash, but, there was the Wall Street movie, and there was all sorts of stuff going on. And so it all seemed pretty exciting to me. And then, to get some shares, and not that it was any great fortune, but nevertheless, for a teenager, it felt like a lot of money. And that was really good. And then it gave me the opportunity. They had this, don't think companies do it anymore, but it was like a regular savings plan. You could commit to buying, $100 worth more every month or something. And, I had a bit of a part-time job. So I signed up for that and sort of built it up. And, I bought some other shares along the journey. But in terms of, the lesson from that, I guess ultimately, that became the deposit for my first home, and it wasn't just CSR shares, of course, but it was about making a start. And, Yeah, that was probably the key for me, really, is that you didn't need to wait until you had thousands of dollars to invest. You could actually start quite small and progressively build on it and learn as you go along. How about you, Bryce? Where did you kick off?
I kicked off way back in, I think year 7 was my first investment, and that was thanks to some good work by my parents encouraging me to save parts of my pocket money directly into a saving account that would be later used for purchasing stocks. So I think they were giving me 50 cents or whatever it was back in kindergarten, and saved all the way through to year 6 or 7. And then there was a float for Brickworks Limited, which was a listed investment company at the time. I think it floated at about 90 cents. And of course, I had no idea what we were doing or anything about it, but I had $500 saved up, and Dad went into his broker at the time, traditional, pen and paper kind of deal, and bought $500 worth of Brickworks. And then from year 7 through to 12, I think we just kept compounding on that and buying. Every time I saved 500, I'd put more and more into Brickworks, but it wasn't until I sort of hit uni that started breaking out into more individual stocks, and I guess developing out the passion for finding stocks and investing that way. So yeah, been investing for a while now. Still hold Brickworks, which is still there. So going strong. Yeah, it's good. Ren?
Well, if Bryce is the example of a good investing story, disciplined saving and buying something for the long term and not selling it, I'm the complete opposite of that. I came to investing a little bit later than Bryce. I was in uni. I threw some money, on different sports bets accounts and stuff like that while I was at uni, and then I was sort of introduced to the stock market. And at first I thought, this is a way you can do some more educated gambling. I guess that's how I first thought of the stock market, and I reckon that's how a lot of people think about the stock market when they're starting out. My first investment was the now infamous law firm Slater and Gordon. I bought it. I bought it right.
What a nasty one to start with.
I bought it right at its peak, and rode it all the way down, lost 99.5% of my money on it, still hold it because the amount that I have left wouldn't even coverage the brokerage cost to sell it. So I literally cannot sell it. So it is a permanent reminder in my portfolio about my terrible first investment. But I stuck with it, naively or foolishly enough. And my second investment, I got very lucky. I got on A2 Milk, the infant formula company that has done very well selling into China, and it is up over 10 times since then. And so with sheer dumb guesses, I guess, more than anything else, my first 2 investments are the absolute extremes of what you can achieve in the market. But what it showed to me was you can only lose 100% of your money. You can invest in the Slater and Gordon and you can lose everything, but your chances of, if you pick the right stock, you can make much more than 100%. And so even though I lost all my money on one stock and made money on the other stock, net I was up. And that really showed me the wealth creating power of the stock market. And since then, I think I've got a little bit more sensible. But yeah, that's the story.
That's awesome, Ren. And I mean, a couple of things there, isn't it? It highlights the importance of diversification. But also, I mean, it's just worth flagging, and no doubt you've experienced it since. I mean, the amount of times that a company goes to zero or near zero, like Slater and Gordon, I mean, it'd be lucky to be 10 instances of that in a decade, I'd have thought. Like, you're bloody unlucky there. It's not, I mean, investments go down for sure, but it's extraordinarily rare that they go down to that extent.
Yeah, it was a good learning experience, and it's a good story now. I crack it out, and it's always useful. Bryce's is too boring.
But also, it means, you don't go. I mean, imagine if your only investment was A2, you'd think you were some sort of investing god, and then next thing you know, you're margin lending and you're doing all sorts of weird and wonderful things. It's probably good to have that experience early to just be a bit humble and a bit, cautionary, I suppose.
Yeah, definitely.
So aside from answering a couple of questions that have come in from our listeners today, Paul, because it's not often that we actually get a financial advisor on the show, and often Ren and I find ourselves saying that we cannot be giving any advice. So good to have a professional opinion, but the conversation today is going to revolve all around building wealth for the long term, particularly using equities. So to start the conversation, I think it would be good for us to all try and answer the question, is it even possible to achieve financial independence via the share market? We know that the Aussies are particularly fond of creating wealth through property. And it's not often that it's incredibly biased towards that sort of asset class. So, Paul, is it possible to achieve financial independence using the stocks?
Absolutely. To circle back to our earlier overrated, underrated, I think it's hard if you're not prepared to leverage. Not impossible. If you're on a high income and you've got a high savings rate, certainly not impossible. But I would think for most of us, you would need to leverage. And if you were building wealth through property investment, you would certainly leverage. So I think that's an important piece of the puzzle. But certainly, share market investment has a lot of advantages that you guys have no doubt discussed in the past. But they don't wear out like a property. You don't need to replace the dishwasher or something. There's no council rates or insurances. There's no potential for land tax. Much easier to diversify, much easier to free up. If you needed $5,000 for an emergency, it's a lot easier to get that out of a share portfolio than it is out of an investment property. So shares have got a ton of advantages. And actually, a lot of the numbers around property I think are pretty rubbery as well. The figures will show, this suburb went up 10% or something, but that doesn't account for the fact that people might have spent hundreds of thousands of dollars renovating the property and putting a new kitchen in and that sort of stuff. So the raw numbers on growth in property I think is pretty rubbery anyhow, whereas the share numbers are they're indisputable. So certainly I believe, and not that I'm anti-property, I think property has its place as well, but I think shares hold a lot of advantages and certainly are a valid path towards achieving that financial independence goal. What do you guys reckon?
Yeah, I completely agree. I think from my point of view, it's the only way I think about achieving financial independence at this point in time. I like the fact that stocks also can generate income and that income can then compound over time. And I think to steal the line from Ren, the stock market is the greatest wealth creating machine in history. And if you just have to look at the returns that it's delivered over, a 10-year period, 20-year period, the power that has over a long period of time. And to your point, Paul, if you apply some leverage to that, I don't see any reason why being in the stock market would not help you achieve financial independence. What are your thoughts, Ren?
Yeah, I think there are definitely other ways you can achieve financial independence. I mean, financial independence is simply a product of required level of wealth, rate of return, and time. Like you could, if you lived long enough, you could achieve financial independence through bonds. But I think the stock market has just proven throughout history to be the greatest wealth creator. And you can understand why that's the case. Property, you buy it, and in the anticipation that the land will appreciate and someone will pay more for it in the future. Same with, art, same with a lot of different assets that people choose to invest in. Stocks have this unique quality where there's a business underlying it, where they are trying to hire the smartest people, trying to exploit new opportunities, trying to invest money in different ways, all for the express purpose of generating returns for shareholders. And if you think about that effect over a long period of time, you just don't get that with any other asset class. And then you see that borne out in the numbers. You see that over the long term, stocks continue to outperform other shares. And there are always periods where, property does better or other assets do better. But over the long term, across the world, stocks continue to do the best. And I don't see any reason why that won't continue into the future.
Yeah, and hey, Ren, just as an extension to that, yeah, it's a great point you raised. When you're buying shares or stocks, and it's just worth mentioning, I've had the odd question, are stocks and shares different? No, it's exactly the same thing, right? Just if anyone's listening and wondering and getting confused, stock, shares, same thing, different word. But you raised there about when you do invest in shares and you're buying into a business, which is different to the other type of asset classes, a key element there is a business makes a profit. Occasionally they don't, but generally they do. They don't pay 100% of that profit out in dividends, right? They're always retaining, depends on the business, but might be half, might be 20%, might be more. And then they're reinvesting that back into the business to buy, take out a competitor or build a new factory or do research and development or whatever. You don't have that in any other asset class. So you've sort of got a natural degree of growth in shares just through the business operating and reinvesting a portion of its profits.
So, Paul, Ren and I obviously sit here and it's a bit easier for us to talk about using the stock market to achieve financial independence because we have time on our side, which is perhaps one of the biggest advantages that we have. You've probably had a bit more experience dealing with people who are a bit older in and a bit further down their journey in investing. How should they think about the stock market and financial independence if they've just, say, started investing in their late 40s or 50s? Is it a different mindset completely, or how do you approach that?
Look, I still think, I'm in my late 40s and I don't like to think I'm old. so I'd like to think that people in their 40s and 50s, geez, we're going to live till we're 90 odd, aren't we? So we've got a heck of a long way to go. So I don't think from that perspective that it means that you have to be excessively conservative and all your money has to be in bonds and term deposits by any stretch. So certainly shares are valid and an important part of your portfolio. I would imagine people in their super are going to have an exposure to shares, and the only question is the proportion that's in shares relative to bonds and property and perhaps other type of assets like that. So, intellectually, if you're in your 40s and 50s, you've got a long way to run. You could have a very high proportion of your portfolio in equities, but you do need to be comfortable with the fact that equities are volatile. Statistically, the Aussie share market has about one negative year every 5. And so if you're going to invest in equities, you need to go in with your eyes open that every now and again it's going to be an ugly year. And that's a problem if you panic and sell, right? So as long as you're going in that, okay, sometimes it's going to go down. It's not always going to be a good year, but that's okay. I'm not going to panic. I'm not going to sell. I'm not going to have a need to sell. So in other words, you're only investing money in equities that you can be confident is going to be able to sit there for a long time and ride out the bumps. Then you're going to get a good experience and you're going to get growth that far exceeds inflation. And then that's going to give you options down the road. So I guess it's just a matter of getting yourself in a comfortable position. And if the degree of volatility of being 100% in equities is going to be uncomfortable for you, and it would be for a lot of people, then perhaps you back that off and you have 70% in equities and you have 30% in conservative assets just to smooth your outcomes, which is the sort of thing that a lot of people in their super fund, they might have a balanced fund, for instance. Right now, that's a balanced fund. Theoretically, it should be 50-50 asset allocation, but a lot of them are more like 70-30. But the reason people are selecting something like a balanced fund is because they're thinking, well, I want the growth, but I don't quite want the volatility with being, all boots in on 100% equity. So how can I smooth things out? So that's, I guess, a bit of self-reflection from you as to how you're going to sleep at night and what's going to cause you stress. As I say, intellectually, 100% equities at that age because you've got a long way to run. But I would appreciate for a lot of people, they're not going to sleep well at night with 100% equities. So you just got to reflect a little bit. And if you're a member of a couple, of course, you've got to make sure that your partner's on board as well. You might be happy with 100% equities, but if your partner's not, then that's not a good way to go. So, yeah.
Yeah, it's always a challenge. You can think that you're going to be fine in a market downturn or if your stock is falling, but you never really know until you open up that brokerage account and you see the red. It's
correct.
It's a gut check moment.
And that's actually, it's a nice reason for doing some investment early in life that isn't, massive amounts of money to experience some losses like that, like you did there, Ren. That was an extreme example. But to know, okay, well, that happened and here's how I reacted, so that then when you're in your 40s and 50s and perhaps you're dealing with numbers that, have some extra zeros on the end of it, you can actually make a decision. Because it is easy when markets are strong and you ask people, well, what's your tolerance for risk? They go, oh, great, let's do it. And then the markets go down and all of a sudden their tune changes. So it is nice to get started early if you can and actually experience a few down periods and see how that made you feel so that then you know how you want to manage things down the road.
Yeah, I think one thing that we've learned throughout this podcast is that getting that discipline and being in a place where you're comfortable if the market turns down can actually come through really good savings habits and being really on top of the amount of money that's coming in every month or however often you get paid, knowing what you need to spend every month, and then having discipline around saving to invest every month and then also saving, for a rainy day fund or whatever it is. Because once you have that discipline and you know how much you've got to spend and how much money you've got to get coming in, when the market does turn, you don't need to panic and you don't need to panic sell because you've got to cover bills or anything like that. If you're confident that you're on top of your finances, then you will have a lot more tolerance if a certain investment turns against you, because you'll have comfort that you know you have the money to cover it, you know you've got your rainy day fund, and the money that you've invested is money that could be invested and could be lost. So I think it's almost counterintuitive to go back to savings when you think about how you prepare yourself for a market downturn, but just getting on top of your finances and being really disciplined about it. And Bryce is looking at me funny because he's definitely more disciplined than I am about it.
I'm not looking at you
But
funny.
I think that's a really good habit that everyone can get into.
That's a great point, Ren, and I guess it's coming back to financial literacy, isn't it? And that's the good thing with the podcasts like we're creating and the people that are choosing to listen to our podcasts. I mean, they're educational. People are listening because they want to learn, and that's an awesome quality, because if you choose to be informed on your financial position and know what's going on, then you're exactly right. You can respond appropriately and not panic. Hey, Bryce, I mean, just talking about this volatility, I mean, your Brickwork shares would have taken a hit during 2008, 2009. How did you respond to that?
Stayed strong. I didn't sell. The only time I sold some of my Brickworks was maybe 3 years ago, and that was just to, I guess, skim some of the profits and put them into something else, but very much still in the position that I bought or have bought over the sort of last 10 years. And I think that just came down to, I guess, my dad pretty much trying to teach me the lesson that, as you said, 1 in 5 years you're going to have a down year, and maybe 1 in 10 you're going to have a much more serious correction, but riding it out over the longer term, generally the share market comes out on top. So I am quite an emotional investor, and I have been burnt before selling stocks when they're on the down, trying to cut my losses, and then they'll rebound to 3 or 4 times what I sold them at. But Bellamy's being a classic example. But look, I think particularly with something like a listed investment company, or if you're buying in the index, there's really no point in panic selling. It's going to bounce. So that's, I got through that.
Bryce barely noticed the GFC.
Nice.
2009, he was finishing high school. He was just playing footy and chasing girls.
Living the dream, huh?
What?
I would love a GFC now, though, because I'd love that buying opportunity, as morbid as that sounds. But to have a buying opportunity like the GFC would be awesome.
Yeah, there's some people that made a lot of money, isn't there? I mean, in some ways, that's the good thing with our superannuation system, is people inadvertently were still buying through super, right? Because their employer's contributing without them thinking about it. And so they were buying through the GFC. But, I mean, as you say, knowing what you know now, you could hit it even harder. But at the time, when you're deep in it, it does feel like the world's coming to an end. So it's kind of easier with a bit of distance, I think.
The thing is, I know a lot of people say, I'd love another GFC. I'd really like to have that buying opportunity. But the stat that has really stood out to me is, so Lehman Brothers collapsed on a Monday, and that was really a key point in the GFC. If you had invested in the S&P 500, so the 500 biggest American stocks, on the Friday before Lehman Brothers collapsed on the Monday, in the 6 months following, you would have lost between 40 and 50% of your investment. You would have been devastated. But if you had just held through the GFC and held into today, you would have more than doubled your money. So whilst you would have made more money if you bought at the bottom of the GFC, you would have been loving it, you still would have done very well if you bought right before shit hit the fan. Like you would be absolutely fine today. And I think that just shows that even the GFC, the worst financial crisis since the Great Depression, if you have the stomach to hold through these bad times, the market bounces back. So whilst I also wouldn't mind a GFC to spend some money, and I do have some cash always just in case, because you never know, I think it's a mistake to try and time the market in that way. I think, the age-old mantra, timing the market beats timing the market, I think that plays out time and time again.
Yeah, good observation for sure.
Equity mate.
Paul, are you a stock picker or an ETF buyer when it comes to your preference for investing?
More ETFs or index funds anyway. I guess, there's a fair bit of research to suggest that, look, if your objective is to hit a particular goal, then the most reliable way to get there is to have a broad portfolio, usually via an index. But intellectually, it's interesting to follow individual stocks. And so I do a little bit of that. And for some clients, we do a little bit of that as well. Particularly, I guess, the mid-cap space. I think at that large cap end, you really might as well go the index. But the mid-cap end is interesting, and I should just sort of caveat, but obviously general advice only and all that sort of stuff. Depends on your circumstances, right? But if purely your focus is, I've got this goal, I want $1 million by X date, and, then you probably would just entirely go the indexes. And if you really wanted to dig in a bit, then maybe you'd think about, well, do I go an index of Asian shares? Do I go an index of healthcare stocks? Do I go hedged or unhedged? There are different things you can think about there. And even, you can use ETFs, of course, to buy bonds or all sorts of other assets as well, gold perhaps. So you can play with that sort of stuff without necessarily going into the individual stocks. But it is interesting to go into the individual stocks from an intellectual perspective. And I know there was one of your past episodes I was listening to where you interviewed a professor out of the US. I can't recall his name now.
Mir Statman.
But, yeah, well, he equated it to, well, look, going individual shares, it potentially costs you a little bit relative to the index, but so does playing golf or doing these other sort of things. But we do it because it's interesting and we like it. And as interests and passions goes, I would have thought following the share market and picking some individual shares is a heck of a lot better than, I don't know, going down to the TAB every weekend or something. So
one of Bryce's favourite pastimes.
Golf is yes, golf.
You guys obviously you love your individual equities, but how do you guys think through picking individual stocks versus just, I'm just going to buy the market with an index?
So I think you've hit the nail on the head there in terms of picking stocks being something that we're interested in. The way I structure it is I have a sort of set and forget long-term portfolio, which is made up of mainly index funds and ETFs. So, your ASX 200, your S&P 500, you're just big broad-based market indexes. And I plan to never touch them, never sell them, and just to average into them. But then I also have a separate sort of, pot of money where I try and pick stocks. And I keep telling myself if I severely underperform the index and I'm not very good at this, I'll stop doing it. But yeah, I'm interested in it and I enjoy it. And I think having a separate bit of money put aside to invest in individual stocks sort of motivates me to do the savings part and all the other parts better as well. So for me, that works. But I definitely do have that long-term index part of my portfolio as well, because you're right. The studies continue to bear out the fact that long-term market returns beats stock picking.
Yeah. How do you play that one, Bryce?
To Ren's point, love trying to pick a winner, a 10-bagger.
100-bagger.
100-bagger. Have had fun in the past doing it. Have also been severely burnt in the past trying to do it. I think for me, the time required to be a successful investor with a portfolio heavily weighted in individual stocks is quite large. And it's something that I don't have at the moment, is time to sit down and methodically research stocks to the point that I'm comfortable with the thesis, with the valuation, all that sort of stuff. So at this point in time, I'm heavily weighted in ETFs and indexes, listed investment companies, letting the professionals sort of take that time and do it themselves, and then I'll just give them the cash and they can invest it on my behalf. Because I'm not a professional when it comes to stock picking, but I know that there's huge advantage in being in the market. So that's kind of how I see it at the moment. If life gives me more time and I become financially independent, I might try and spend more time choosing specific stocks. Don't get me wrong, I still do it, but to the extent that I was doing it when I started investing, it's now sort of drastically reduced, and I just average into ETFs and listed investment companies each paycheck that comes in.
I was just going to ask, in terms of the indexes that you guys do you always just go the straight indexes like the S&P 500 or the ASX 200, or do you ever go equal weights or hedged or particular sectors, like I say, the healthcare sector or the tech sector? Do you get into any of that sort of stuff?
I do. I like the boutique sort of indexes that can give you exposure to, I guess, a theme that you're interested in. For example, marijuana or biotech, healthcare, whatever it may be. That's probably one of the biggest appeals for ETFs and indexes for me, particularly in the States. You know, I like thinking about the macro trends that we're seeing and what's the implications for those. You think about the growth in middle class from Asia. What impact is that going to have on Australian businesses? You can get ETFs now that give you exposure to India. What's that going to mean over 20 years? And there's more products that allow you to invest sort of based on macro themes. So yeah, I don't just stick with the broad, heavy-hitting ASX 200. For me, not as exciting. Yeah, they're stable. You get some good dividend return, but also in terms of capital growth, probably not the same as if you're looking at maybe even a small cap index, a mid cap index, or emerging markets. So all things that we've sort of discussed. Ren?
I'm the same. I have some, theme-focused ETFs, cybersecurity, stuff like that. I have some like emerging market ETFs and stuff like that. I think when you talk about the research around index funds, it generally seems to be, there's obviously a longer history there to research, but I think the broad-based market ETFs are the ones that have outperformed the best over the long period of time. I love the idea of equal weighted indexes because intellectually it seems to make sense that a lot of the growth in like the S&P 500 or the ASX 200 comes from the stocks lower down that list getting bigger, whereas the bigger stocks are already quite large. But I haven't seen research that shows that equal weighted indexes do better over a long period of time than just market cap weighted indexes. But look, that's a long way of saying I think spreading your money around different indexes, different geographies, different themes makes sense in the same way that diversification generally makes sense.
Yeah, spot on. We could probably do a whole episode on index funds and different ETFs and that sort of stuff. There's heaps there.
Absolutely.
We've done about 100 episodes. It still is our number one question that we get from listeners.
All right, Paul. Well, before we jump into a quick speed round of some questions that have come through from our listeners, we noticed that you had an episode titled The 10 Worst Things You Can Do to Prepare for Early Retirement. What are those 10 things? Very interested to hear this because I'm sure I'm doing 6 out of 10 of them.
Well, let's hope not. All right, let me run you through them. All right, so the first one is not having a budget or any sort of sense of cash flow. Number 2, living on a credit card. So these are both, I guess, ability to save, which ties into number 3, not saving. Right? You're never going to get there if you're not saving, if you're not managing your cash flows, and if you're blowing out the credit card. From there, if you're not investing, you're not going to get anywhere. Sitting cash in the bank, you've got no hope. Investing too conservatively, right? Again, term deposits, this sort of stuff. You're not going to get the compound growth that you need. Ignoring your super. I mean, a lot of people do. It's, perhaps it's boring or whatever, but the reality is it's going to build up to a lot of money. And if you have that invested, in particular, more conservatively than it needs to be, you're wasting an opportunity. Or if it's an expensive fund or if it's got insurance in there that you don't really need, this sort of stuff. So don't ignore your super. Another mistake would be to be checking your balances every few days. Markets go up and down, they're volatile. Checking them every few days isn't going to help. It's likely to just lead to bad decisions. Spending hours reading fire forums, and we've probably already touched on that, right? Having no hobbies or interests outside of work, because if you're going to retire early and you want to be happy when you retire early, if all you ever do is work 6 days a week, 14 hours a day, great, you're going to get to retirement and then you're going to be miserable because you've got no friends and you've got nothing else to do. And then the last one is focus so much on retiring as early as possible that you ignore your important relationships, your partner, your kids, that sort of stuff. Your kids are only young once, and if all you're worried about is how can I retire at 30 or 40 or whatever it is, and meanwhile you never get to your kids' school play or their awards ceremony or coach them at basketball or whatever it is that floats your boat, well, it's a wasted opportunity. You'd be far better off easing off on the work and not worrying quite so much on the money and enjoy your family while you've got them there. So that's my 10 worst things that you can do to prepare for retire early. What do you reckon, guys?
I like it.
Yeah, I think
Thankfully,
it's good.
From my point of view, I'm not falling against many of them.
Except you hate read fire forums.
Yeah. I think it's a good segue into one of the questions that has come through. You mentioned there, Paul, not considering your superannuation or thinking about your super. And, if you're young, it's probably something that you're not paying as much attention to as someone who is probably a bit older in life. And then it brings into question self-managed super funds. So one of the questions that has come through is, what super balance do you kind of need before it's even viable to consider opening a self-managed super fund? It'd be fun to take control of the money that was in there and invest in the way that you'd like, but I'm sure that there's a tipping point where it doesn't really make sense. Do you have a view on that?
Yeah, I do. Generally, a real lot.
Yeah.
I mean, there's a lot of solutions these days, like even I think Australian Super, where you can buy direct shares through Australian Super.
They give you heaps of control.
Correct. And there's lots of other solutions, wrap funds, that sort of stuff. So if your reason for going self-managed super is because you want to invest in equities, then you don't really need a self-managed super fund to do that. So, the amount that you need for that, well, probably north of $500,000 or something like that, like a lot. Because you could more cost effectively do it through a lot of other solutions. Now, most people go self-managed super because they want to invest in property, and that's not so easy to do, and that's probably a different discussion. But yeah, I don't know, just certainly if you're going to go into self-managed super, go in with your eyes open. At the very least, you've got accounting and auditing costs, which is probably $3,000 a year, and that's without doing anything else, without any brokerage or anything else. It's highly likely that you could find a lower cost solution that would get you the same outcome that you're trying to achieve.
Yeah, so it's primarily due to the running cost of the super fund that you need a decent balance. Otherwise, you're probably going to be paying fees that are higher than your return. Hopefully not, though.
Exactly right.
Yeah.
Like your annual return and your audit are roughly the same, no matter how much you've got in there.
Yeah.
So as a percentage, it's fine if you've got a really big balance, but if you've got a smaller balance, it's just going to be a killer.
Yeah.
So one other question that we got, which I think a lot of people wonder, was about investing in the share market and paying off a mortgage, and asking if they can do both or should they prioritise one over the other. Do you have any thoughts on that, Paul?
Yeah, it comes up a lot. We get a lot of questions on this as well. Yeah, I reckon you can do both, but I think you have to pick one as your priority. And there's arguments both ways. It's nice to get the mortgage paid off. It's a certain outcome. The flip side is interest rates are very low at the moment. Maybe you'd be better investing in growth. So there's no one right answer, but pick one. Still have, if your minimum's $1,000 on your mortgage, we'll pay $1,200, right? So you're doing something more than the minimum, let's say, and then the rest to your investment, if investment is you decided, if that's your priority. Or you could flip it the other way and put most of the mortgage and just put $200 a month into an investment. And you can do both, but I think you've got to decide which is the number one and which is the number two here in terms of order of priority. How do you guys think about that one?
I think there's probably a mathematical and a psychological way to answer this. The mathematical one is if your interest rate on your mortgage is, I don't know what it goes for these days, 4%, and you can earn 8% in the share market, then mathematically it makes more sense to take the higher return. But psychologically, there's something really meaningful and encouraging about paying down your debt and seeing that balance reduce. And that might encourage you to, might give you more motivation around your money moving forward. Take some of the stress off with that, big debt hanging over you. But I think you're right. I think doing a bit of both is the right way to go about it. But the best investment you can make, better than investing in the share market or paying off your mortgage, is paying off credit cards, because the interest on that is outrageous. So that should be your number one focus over both of these things if you have credit cards.
Good point. Bryce, what do you reckon?
Oh, look, I don't own a property, so it's not really on my radar at the moment. But if I did, hypothetically speaking, I would certainly try to continue putting money into the stock market. Thinking back to what my sort of parents taught me back in the day, it doesn't matter how much you put in as long as you're putting something in. So it could be, even $10. And I know that's probably, a little bit too small, but the principle is there, if your priority is to pay the mortgage, make it your priority, but just keep ticking away in the share market. It's got great advantages. So that's how I would approach it.
Yeah, nice one.
Now, Paul, this one might be asking you, to talk your own profession up, but is there an advantage in having a financial advisor? And if there is, how do you find a good one?
Is there an advantage? Yeah. So Of course, I think there is, because I am a financial advisor. That's not to say that everyone needs a financial advisor, to the same extent that there are some people that maintain their own cars and do their own oil change and that sort of stuff. But I don't. I take it to a mechanic, right? So I think most people would benefit. Now, whether they just need a one-off, let's put together a strategy and then they're good to go, or whether they need an ongoing relationship, there are different ways that you could tackle that. But, yeah, I think most people, if finance isn't their day-to-day game, then they're going to get benefit out of talking to someone who thinks about this stuff all the time. It's the classic you don't know what you don't know. So, and there's just some good value in having a discussion around, well, what are your goals and how are you working towards achieving those goals? Because a lot of people just kind of float along and live your life, and maybe you don't think too much about, well, where do I want to be in 10 years or 20 years? So I think there's a lot of value in those kind of discussions, and that's what you'll be doing if you're sitting down with a financial planner. In terms of how you find one, look, I think probably the best place to start is to ask friends and family for a recommendation. If there's someone you know and they say, yeah, look, I work with this person and they've been really good, well, then that's a pretty good place to start, I would have thought. You can check, there's an ASIC register of financial planners, so you can always check that people are appropriately licensed. And I guess if they call themselves a financial planner, it's a word that's for financial advisor. They're restricted words under the legislation, so they shouldn't be using those words if they're not. But nevertheless, you can check the ASIC register. I guess there are some people that call themselves money coaches, and the reason they call them that is because they're not licensed, and that's a term that anyone could use. So be a little bit wary there. But, yeah, you can always check the ASIC register. And I guess the other thing is most financial planners, your initial appointment, discovery type meeting, there generally won't be a cost for that, or if there is a cost, it's not a huge amount. So you do have the ability to go and see a planner and just kind of see if they're talking your language, if you feel like they sort of resonate with you and they're on the same page. And if they're not, you're under no obligation to keep going. And like I say, in most cases, the planners will wear the cost of that initial appointment. So, yeah, don't be afraid to sort of shop around. And if the first person that you sit down and have a chat with isn't right, then try someone else.
Nice.
So I guess following on from that, some of the questions we got were around financial planners and financial advisors having a fiduciary obligation. So I'm not even going to try and answer this. I think you're the expert, so I'll let you answer this one, Paul.
Yeah, so that fiduciary, that's a way that they categorise advisors in the US. So the standards here in Australia are higher than in the US. So all advisors have a best interest duty, have to act in the best interest of their clients. And so that's, if something's wrong and you end up in court, then that's what you have to prove, that you're acting in the best interest of the client, that's what fiduciary means, right? In the States, they kind of have two categories. So they have advisors that have fiduciary, but they have a sort of a lower level, which are really just people employed by fund managers or banks to essentially sell their products. So they kind of have this two-tiered process. We don't have that in Australia. Anyone that is giving advice has to meet that best interest duty classification. So, yeah, so certainly high standards here, and I guess there was the Royal Commission earlier in the year, last year, that sort of stuff, shed some light on some poor practices, particularly from some of the larger banks. And so that's led to a really big clean out there, which is great. And, the standards, there's further things that have been legislated for a while that are progressively being rolled out. And, the standards are very high. And I think there's always going to be one or two bad apples in any profession. But I think overall the standards in Australia, they really set the bar globally.
So the final one, and this comes, and I can actually speak to this. So I have an emergency fund, Paul, that I've been saving up for a while. It's, 3 to 4 months worth of total living expenses, rent, bills, you name it, covers the lot. Sitting in cash, it's quite psychologically difficult to see it sitting there, knowing that the cash environment at the moment is pathetic and it could be put to better use. And this is something that a couple of our audience members have also asked. From your opinion, is it best to sort of just sit it in cash? How do you think about an emergency fund when it comes to this sort of thing?
If you've got a mortgage, you'd sit it in an offset account, but you don't, Bryce. So for people that don't, I don't really see any great alternative there. Sorry. Interest rates are low at the moment.
It's damn you, interest rates.
So get a mortgage price.
Yeah, true. Maybe I need a mortgage.
There is some value in just having a bit of liquidity. Anything else is going to tie up your money. Yeah, I reckon you just have to cop that on the chin. Sorry, mate.
No, look, I expected that would be the answer. There's no silver bullet when it comes to that sort of stuff.
No.
Just risk it. No emergency fund. See what happens.
That's how Ren would play it. But awesome. I think that was a bit of a one-sided convo there, but there were some specific questions that I guess we probably can't answer. We don't have the expertise to do so, which is why it's awesome to have you able to answer them on I guess, our behalf, Paul.
Yeah, no worries. Hopefully it was helpful.
So, brings us to the last final 3 questions that we always do at the end of our interviews. I thought it would be great if we just go around the grounds, as they say,
Sure.
to answer the 3 of them ourselves. So, Ren, I might start with you briefly. What is Ren can really yabber when it comes to books. So, what is one of your must-read books, investing or otherwise?
I'll just say one.
Yeah, well, it says one.
So the book that I go to is a great book with a terrible name. It's by Patrick O'Shaughnessy, who people might be familiar with his dad, Jim O'Shaughnessy, who wrote What Works on Wall Street. But Patrick wrote a book with a terrible title called Millennial Money, but it is a cracker for beginner investors. I think it's the best one I've read to really get you started. And do you see how I actually slipped 2 books in there?
He's pretty active on Twitter too, so
He is, yeah. Worth following.
Yeah. How about you, Bryce?
Look, Ren has stolen he put me onto this book, Millennial Money, and I agree. It's probably one of the easiest but also most rewarding investing books that you can read, particularly for a millennial, as the title suggests.
But not just for millennials.
No, there's some great strategies in there and I guess ways to frame the market. But if I was to give one that is perhaps not investing related, but more sort of business entrepreneurial, Shoe Dog by Phil Knight, which is the former CEO and founder of Nike. Fantastic book, great insight into the struggles that he went through to start Nike, and I guess just goes to show how perseverance can really pay out in the end. So awesome book to read. What about yourself, Paul?
Yeah, wholly endorse that. I love Shoe Dog. And didn't he go back to uni or something to learn how to write so he could actually do a good job? It's really good book, that one. Look, the one I'd throw out there, a bit of a different flavour. It's an old one, but have you guys read Barbarians at the Gate?
No.
It's I don't know when it would have been written, probably in the 90s. But it's 2 journalists, and they track what at the time was the largest corporate takeover in American history. It was the Nabisco, the biscuit manufacturers.
Okay.
And the backstabbing and the double crossing and it's quite incredible just how that all unfolded. The 2 journalists, I'm not sure their background, but they're clearly, they're Wall Street Journal type quality journalists, and it's just a page turner. Hunt that one down. Barbarians at the Gate would be my tip.
Nice one. So second question that we always ask is, what's your go-to source for financial information?
Yes, I'll take a swing at that to kick off. Financial Review, I have a skim through that every day. And if I want graphs, which sometimes it's just nice to see that historical context, then I jump onto Yahoo Finance and pop the graphs in there. We do have some researcher subscriptions as well, but certainly AFR and Yahoo Finance for graphs are my starting points. How about you, Bryce?
I start my Mondays with Equity Mate's Thought Starters email.
Of course you do, as do I.
No, very similar to you, AFR Daily. We've spoken on the show before. Reddit's a great source of information. I do like getting around FinTwit, financial Twitter, and just general chat with our mates always brings up good conversation and then can sort of trigger some further research. So that's how I go about it, Ren.
I'm going to say all of the above, although I understand that I shouldn't be reading as much day-to-day news, financial news, as I do. But a really good one that hasn't been mentioned, I think, is Reddit. And some of the specific subreddits, investing, security analysis, have just some great resources that this global community are sharing. So that's definitely a good one to check out.
Hey, just another, sorry to have an extra swing at it, but there's the email Morning Brew. I don't know if you guys check that one out, but it's pretty US specific, but it's not bad. I don't mind that one either.
Yeah. I'm a big fan of some of those mailing lists. We did a few live shows with Finamize earlier this year. They have a good mailing list. Quartz, Quartz, is a good one as well. So there's a few good ones floating around.
Good. Well, how about I might have a swing at this last one or kick you guys off. A piece of advice that you tell your younger self. Ren, what do you reckon?
Well, I guess I am getting older now. So
A ripe old age of 27.
yeah. I think that I had a lot of lost investing years, not learning to invest until late at uni. So I think I would say to my younger self, take a page out of Bryce Lesky's book, who I wouldn't have met yet, but and start saving and start investing while I was in high school. I think getting those habits early is really important, and then I would have been able to invest in the GFC as well. So that would have been nice. What about you guys?
Do you want to go, Bryce?
Yeah, sure. So for me, I would tell myself, I spoke about it earlier in the show at the beginning of my investing journey. I was trying to be Warren Buffett and choose individual stocks. So I would say forget stock picking, stick with the LICs and the ETFs, even though ETFs back then were sort of relatively new on the scene. But I would certainly be, forget trying to pick the 10 baggers and just stick to the LIC managed fund sort of stuff and ride it out from there. What about yourself, Paul?
Yeah, nice call. I think for me, look, I wasn't a slacker, but if I could tell myself something, it'd be just grow up, just crack on a bit, Like I don't know. I mean, like I say, I went to uni at night, so I was working during the day and 6 years of uni. So it wasn't that I was slack, but I was probably more concerned about, I don't know, fitting in and wanting people to like me. And, now looking back, worry less about that would be my advice to myself, I suppose. And, just think about where you want to be 10 years down the road and take some genuine actions to make that be able to happen rather than just kind of float along and do what you think everyone else thinks you should be doing.
Yeah. Good piece of advice to close out the show. I think from our end, Paul, it's been awesome to have someone that we can bounce some more financially specific advice-related questions off. It's not often that we get someone like yourself on the show. So from our end and from our listeners, thanks for joining us. It's been fun.
Yeah, and look, from my side too, I mean, I've had a ball and I'm sure all the Financial Autonomy listeners will love hearing your voices. And as I mentioned earlier, for the Financial Autonomy guys, if you haven't yet checked out Equity Mates, definitely give it a go because these guys put out a great podcast and lots of interesting content. So, thanks for having me on, guys. I've had a ball and I don't know, hopefully we can do it again sometime.
Yeah, definitely. We'll look forward to seeing the podcast grow and hopefully the Australian financial podcast community continues to grow with both of us.
Spot on. All right. Thanks, guys.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.
Equity Mate.